12 lessons from the world's greatest stock traders. You know, when you look at our brand, Follow the Money, barely probably see that on the back of my computer, laptop, the train, you've probably seen that on our website. You may notice a little nostalgia in our brand, and that's because so many of the new modern gimmicks today don't work in trading. There's always a new gimmick. There's always something new that's being passed off as some sort of, brand new way to make money in the markets. The wise King Solomon said, "There's nothing new under the sun." Right? The same thing happens over and over and over again, and that's the same thing in trading. We're going to talk today about what works, and if you want to succeed in trading, you do well to study trading success. And that's why we're going to be focusing upon these traders of yesteryear, traders who used very time-tested principles, although many of them, like our very first trader we're going to look at, Gerald Livermore, didn't know at the time that he was really using time-tested principles. In fact, he was kind of a trailblazer, if you will. He was one of the very earliest traders of the 20th century, and Gerald Livermore was a fairly young guy, about 14 years old, whenever he ran away from home. And his father was a farmer. His father wanted him to stay and work on the farm as a farmhand. Gerald Livermore was a kind of a math whiz, really good with numbers. And he actually completed 3 years of math classes or math schooling in 1 year. So he had a really big gift for numbers. And his father, at the age of 14, wanted him to drop out school and become a farmer. And this horrified young Jesse, he decided to run away and told his mother beforehand, and she gave him basically $5, which was really about worth $100 back then, and sent him on his way. And so he soon found his way to a major city, and before long he found a job at, I want to say Payne Weber, and he was a chalk boy. And so what he would do is back in these days, of course, they didn't have stock charts, they didn't have all the indicators, fancy indicators we have today, and so Jesse would stand up, at a board, and he would write with chalk on the board. Later on, we see this became more sophisticated whenever we came up with the ticker tape. Here's a picture of the ticker tape created by the Edison Company in 1869. And the ticker tape basically was kind of what we had before we had stock charts. Many of the guys who we're going to study today did not have access to charts. Imagine trying to trade the trend without a chart. What did these guys use? Well, they used the tape. So you might have heard that before. Don't fight the trend, same thing as don't fight the tape. And so, one second here. I think I messed up my slides. There we go, okay. So don't fight the tape. Well, as I was mentioning, Gerald Livermore began working as a chalk boy, and pretty soon he discovered that there were patterns he was noticing as he would write on the board. And so pretty soon he started trying his hand at trading. And so he would take his money and go down to the bucket shops. Who's heard of the bucket shops before, back in the early days? Bucket shops were kind of, it's kind of hard to compare what they are today, but basically you could bet on a stock, a direction of the stock, without actually owning the stock. Kind of like an option, I guess, but it wasn't really even an option. And pretty soon, he was so good at this, he would so easily identify the trend from the tape that he was making money from bucket shops, and they would ban him. So he wasn't able to come in, and pretty soon he was banned from every bucket shop in his city, and so he would have to travel to other cities, and pretty soon he would get banned from bucket shops there. And then, of course, he went on to build multiple fortunes, and then he also lose those fortunes. He's quite a story to study, Gerald Livermore, quite a story. In 1907, he earns about $1 million from the panic of 1907, and then he turns around and loses that fortune in 1914 at the beginning of World War I. Then in 1929, he successfully sees the market topping, he sees it entering stage 3, and then he sees it beginning to downturn, and he shorts, makes what we would say today is basically $1 billion from the stock market crash of 1929. He made so much money from shorting the market that J.P. Morgan contacted him and told him to stop shorting the market. It was a pretty big deal. He was a pretty well-known guy. Well, this Jesse Livermore made so much money from the market that he had everything that he ever desired. I mean, he had horse-drawn carriages. He bought castles. I mean, he had so much money it was insane. And it was all because he understood how to read the tape, how to understand, how to follow the trend. There's another gentleman by the name of Nicolas Darvas. Some of you have heard of him as well. He was a Hungarian dancer, born in 1920, and he studied economics but never really got into trading. And in 1952, he was planning on him and his dance partner, her name escapes me now. Forget, anybody remember what his dance partner's name was? Forget his dance partner, this not. Oh, Julia, I think Julia was her name. They were invited to dance at this particular function, and he was going to be paid in stock. Well, he ended up not dancing. Something came up, and he decided to buy the stock anyway, out of courtesy to the guy who had offered it to him. And it was Bryland Mining Company, a little tiny little gold mining company, a little penny stock. And he bought the stock, and within about 10 or 12 months, he kind of put it away and forgot about it. And in 10 or 12 months, he realized he had made thousands of dollars from this little penny stock that he didn't even know really what it was at the time, and it was extremely ecstatic. Then began taking that money and began investing in the market. By 1961, he had amassed a $2 million fortune. His book is out on my table, and it's called How I Made $2 Million in the Stock Market. He read more than 200 books on the stock market trying to identify the holy grail of trading. He traded, by the way, by telegram. Oh, thank you very much. We do have a handout, by the way, for today's speech, and Jennifer's going to pass that out for you. He read 200 books on the stock market and also traded, as I mentioned, by telegram while traveling and performing in his dance act. He would basically get a copy of Barron's magazine. He would read it on the weekends, and then he would place his trades by telegram to his broker. And using this method, he was an extreme part-time trader. I mean, he is just the perfect example of a part-time trader. And here's a copy of his book. You can see the copy here right on the front cover. And notice all of the things that he comments in his book that he realized didn't work. He goes through this list, and he mentions that tips and rumors certainly failed to make him any money. He started there. Then he moved on to investment newsletters. How many of you buy investment newsletters looking for tips and ideas? Well, he tried that, and then he got broker advice. He got stock market books. Then he annual reports and fundamentals. He figured he'd try to trade fundamentals. Then he focused on over-the-counter stocks, even some penny stocks. Then he started focusing on the insiders and in-depth research. And then he finally realized, after all of that, and he describes all of this in his book, that it wasn't until he finally understood price, volume, that things clicked, and he started making money. His book, by the way, that he put out, that book that you see, sold more than 200,000 copies in just 8 weeks. It's a fascinating read. How many of you have read that book? It's really a great book. I encourage you to pick up that book before you leave. We have all of those books, by the way, back on the table, priced at Amazon prices. So there's no markup. I mean, we literally just want you to walk out with those books because they're very, very powerful. Now, as I mentioned, Darvas relied upon the Barron's. His broker would mail the Barron's magazine to him, and then he would simply send his trades to his broker by telegram and his buy and sell orders. And it's really fascinating. In the book, you can see copies of the telegrams that were sent. So again, Darvas, an extreme part-time trader. You can see here the Darvas box theory. The Darvas box theory is basically a momentum-based strategy where the Darvas box is an area of consolidation. And when the stock breaks out of that Darvas box, or that sideways rectangle, when it breaks out to the upside, he would buy and he would add. And he would just keep doing that whenever he saw a stock getting inside of a sideways consolidation pattern. Now, here's a few of the things that he comments on in the book, just kind of a little Cliff Notes version. He says that he focused strictly upon rising stocks with earnings growth. Again, this is something that we strongly advocate. He preferred stocks hitting new all-time highs, especially on higher than normal volume. This is coming from a guy who made $2 million in less than a decade, doing it part-time. He used buy-stop orders to enter a stock with a pilot buy, which we're going to talk about in our next session about pyramiding. In fact, we'll talk about pyramiding a little bit in this session as well. So he would pyramid into the stock if it continued rising. That is, he would keep buying. He would average up as the price went up. He used stop losses to limit his losses. He let his big profits run until they ended. He would only hold 5 to 8 stocks at a time and up to 50% of his total trading capital in a single stock at one time. So you can see most of these guys never really held, that we're going to cover today, never really held more than just a few stocks. Usually, 8 stocks is really kind of a lot for one of these traders. They really focused deeply with their trading capital upon just a few great stocks that were rising, setting new 52-week highs, and rising on strong earnings growth. He had a strong emphasis upon self-discipline and patience. We're going to see that constant theme as well. Then there's Bernard Baruch. Bernard Baruch was a very famous man in his time. In fact, one of the most famous men of his generation. He was born in 1870 in South Carolina. He was a graduate of the City University of New York. He was a big philanthropist of his day until he died in 1965. He helped President Woodrow Wilson during the World War I era. He served as an advisor to 7 U.S. presidents and the UN, and he is the one who actually coined the phrase, the Cold War. That's where that word comes from. That phrase comes from Bernard Baruch. He earned his first $1 million by the age of 25 trading the markets, and he purchased his seat on the New York Stock Exchange for $18,000, became a successful stock broker, and really built quite a fortune that still lingers to this day through his foundations that he created. So Bernard Baruch lost money for the first 6 years of his trading career. This is really interesting. 3 reasons that he is mentioned for failing was 1, he failed to do his own research. He relied upon other people. Number 2, the lack of knowledge and experience. And number 3, a reliance upon opinions instead of trends. From his own mouth, this is what he had to say. His trading luck changed when he began to understand trends, and he stopped fighting the trend and instead decided to go with the trend. Bernard Baruch will have a lot to say in this speech. We'll turn back to him in a few minutes. Then there's Gerald Loeb. Gerald Loeb is one of the very unusual traders you don't hear about too often. He was wildly successful in the market, but he lost a ton of money in the Great Depression. And he walked away from the Great Depression kind of battle-scarred. And in fact, the name of his book, The Battle for Investment Survival, kind of conveys that. He depicted the market as a battlefield and kind of adopts the same idea that William J. O'Neill of Investors Business Daily adopts, in the fact that William J. O'Neill says that all stocks are bad. The only ones that are not bad are the ones rising. So he kind of adopts this kind of pessimistic view of the market from Gerald Loeb. Gerald Loeb is by all means the greatest influence upon William J. O'Neill. We'll look at him in a minute. But Gerald Loeb was a founding partner of E.F. Hutton. You've probably heard of that before. And he went on to make a lot of money in the markets. But again, a very defensive trader, very analytical mind, and he has a lot of great things to say. William J. O'Neill credits The Battle for Investment Survival by Gerald Loeb as his #1 most important book that every trader should read. We have it back on the table at Amazon cost. I encourage you to pick that up before you leave, or pick it up at some time at your leisure. It's a really important book. It's a great read. And he defines in fact, he probably gives the best definition of the topic of investing on the very first page that I've ever seen. It's a fantastic book. Then there's William J. O'Neill. Here he is when he's just a young lad. William J. O'Neill went on to found Investors Business Daily, and William J. O'Neill was the very first person to put together a stock market database of all stocks. And what he did was he learned from all of these previous guys. He knew, he had read about Bernard Baruch. He read voraciously about Jesse Livermore. He read about these guys who did not have access to what he had. And he read about Nicolas Darvas and, of course, Gerald Loeb. And he said, okay, let me put all of the stocks that exist into a database and let me begin to look and search for patterns. And so he really is, I got to say, probably one of the most important traders of our generation in the fact that he puts together the very first stock market database of its kind. And he identifies that over time, stocks make certain patterns before they break out. One of the ones that he noticed most importantly was the cup and handle pattern, very powerful pattern. And this takes us into lesson number 1.